Every now and then, you just have to go back to basics. Mutual funds, exchange-traded funds, individual stocks, individual bonds. What are they? How do they work? And how do they apply to you? Join us on Consider This program today. We'll break it down, give you some good ideas and things you need to consider. Back in good old 1924, mutual funds were created under a Unit Investment Trust Act. We're going to talk about that today on Consider This program. I'm your host, Joe Clark.
And I'm Darren Hardesty.
We're happy to have you along. Darren is one of our senior advisors at the Financial Enhancement Group. So what we're going to do is to take us back to basics. We're going to talk about why mutual funds were created, why exchange-traded funds were created, what an individual stock is and what an individual bond is, and how we got into this predicament where the largest owner of exchange-traded funds are mutual funds, and why people are still buying mutual funds. I had somebody come in the other day, over $1 million in an account, paying an advisor about 80 basis points. So that's what he thought his cost was, about 0.8%. Seemed to be very reasonable. We would have charged 1% for the same portfolio. That's the fee. However, he didn't understand that the broker had put him all in mutual funds, and that he was paying the mutual fund manager another 1% on top of that, plus all of the expenses inside of the mutual fund. So in all fairness, it was twice the price of what we would have charged to do the same thing. There's a lot of confusion and neglect that go on in portfolios when you don't understand the tools you're using. So this is probably not fair to Darren. I'm a history buff. So is he. But, I'm going to ask you, when were mutual funds created? I already gave you the date. Mm-hmm. When were mutual funds created? What were the three types? And why were they made?
Ooh, man. That's a good question. So 1924.
1924.
Let's start with why. The reason that they were created is because the stock market at that time, think of the roaring 20s, was taking off, and there's a lot of wealth that was being created in America, and people that were able to buy stocks typically had what we call older money, or money that they could get into the market, and stocks were very expensive. And the average person, or
the trading of stocks was very expensive.
The trading of stocks. Okay. But to the average person who just had a regular job, they didn't necessarily have the amount of money that it took to be able to actually participate in the stock market. So mutual funds were a way that it would allow common people to put a little bit of money, by a fraction of a share, if you will, and be able to get a basket of different stocks at a more affordable price than what they would if they had to buy the individual stocks. So it essentially allowed the common man to have participation in the market.
Pretty good. I would give you a B+.
I'll take a B+.
I'll give you a B+
on the spot,
on that
B+,
one.
all right.
So you have to think about this. So back then, 1924, if you were going to buy or sell stocks, right, you had to have somebody in Philadelphia, Boston, New York, Chicago, right? Mm-hmm. Those are the four primary trading locations, if you will, right? So there was no email, there was no fax machine, so Darren had to get me money. I had to, as the money manager, had to buy stocks for Darren, right? And then I had to, in my ledger on paper, right? I used to deliver newspapers in Muncie, for the Muncie Star, right? And I had a ledger from Hooks, the drugstore. You got to be really old to keep up with me some days, right? Where I would write down the Hardesty family, and I would be able to check off whether they paid me or not, right? So that I knew that I'd been covered for the cost of the paper and for my time and service of delivering it. Mm-hmm. That's what the broker had to do, and everybody wanted to be involved in the market, right? And so in 1924, the United States created the Unit Investment Trust Act, which created three different types of mutual funds. Right?
All right.
You ready?
Closed end.
Closed end. What's closed end mean?
Closed end means that you are inside what you own is yours, and so like an open end is another. Where an open end, money can go in and out, and it's the way that the value of the money is different. The net asset value is different, how it's calculated.
So your 401k, any of you who have a 401k, are almost always open-ended funds.
Correct.
So in each of these three trusts, a mutual fund is nothing more than a trust. Never forget that. And it's not a trust like your trust work that you have or your legacy plan. It's It's a trust of ownership, and it's important to understand that. One of the biggest misnomers with a mutual fund is people will say, well, I own the underlying stocks. No, you don't. No, you don't. You own a unit of that trust, right? Which is very, very critical for understanding how the taxation works. So in an open-ended trust, in a mutual fund, you put money in. There's a manager or a management team that buy and sell things at their discretion, right? They do have fiduciary duty, but you have to understand it's not to you. It's to the trust, right? So if they say that they're a large cap value, then their job is to stay within that investment guideline of large cap value. They're not supposed to meander or wander around, though we see a lot of that slippage, if you will, that occurs. But you put money in, the management team manages it, and then when you want your money out, it is the responsibility of the mutual fund to sell your shares in the trust, right? However they want to. They could use cash. They could sell stock that's in there, which creates taxes for your neighbor. Congratulations. But it's the job of the mutual fund to be able to distribute the money. Okay. Now, the second kind was a closed end, and that's all they used back in the 20s. The open end really didn't happen a lot. The closed end is identically the same. You put money in, you still have a management team, but when you want to sell it, you have to find a buyer. So very, very often you find closed-end mutual funds trading at what we call a discount. When you have huge disparity in the market, huge amounts of volatility, 08, 09, Adam and Andrew and myself will go in and we will buy closed-end mutual funds. It's the only mutual funds we've ever owned. And we will buy them because we can find them at such a dislocated value that you may have a 30 to 40% opportunity. That's what we saw in 08 and 09 because people simply don't understand what we're talking about right now, don't understand what it is they own. You know, when people call their broker, when they flip out, they just sell it all, right?
Yeah.
So you've already had the stocks go down in value that are inside of the fund, right? And now in a closed-end fund, you've got to find a buyer.
Yep.
And there isn't a lot of liquidity in a market correction, right? And so the premium or the discount rather even widens, and you know it's a wonderful, wonderful thing. Now, Darren mentioned a word, NAV, net asset value. That is true for all three of these trusts. It's true for an open end. So at the end of the day, the manager of an open-ended trust, an open-ended mutual fund, is to add up the value, divide by the number of units of the trust that are sold, right? And some of these things have $30 billion invested in them, right? 30 billion, that's a lot of money. But they divide by that, and then they will tell you the net asset value of each individual share. Same is true in a closed-end fund, right? In an open-end fund, the manager is responsible if you call in before 2 o'clock in the afternoon, and the manager, and you ask for a liquidation, the manager is responsible for giving you whatever the NAV is at the end of that day. Again, in a closed end, Aaron, what happens at that one is where the manager has no obligation. He's going to tell you the net asset value, and then you've got to negotiate with Wall Street how much you're willing to accept. Again, the word premium or discount come into play. The third one is a unit investment trust. It's merely a bucket of stocks with no manager. Right? You still get an NAV, right? But you know exactly what the holdings are inside of that basket. Those were the three, right? And you went all the way through life until the mid-'80s. And in Canada, they came up with this crazy idea called an exchange-traded fund. I think the first one was 1986. The big three in the United States started in 1987. So right when I'm getting into the industry, right? And I've always said I'm the Rodney Dangerfield of the industry, right? It's, you know, nobody taught me this. I had to learn it on my own. I don't come from a family of money. I come from school teachers, right? I had to learn this on my own. And then I went and got the academic side and the CFP part and, you know, ended up teaching at Purdue. So you can call people out when they're crazy when you had to learn it on your own, you know, as opposed to an instructor telling you, here's how it is. But the exchange traded fund was created, the first three in the United States. Do you remember what they are? The number one traded thing every day on Wall Street.
SPY?
SPY. We call it the Spiders. That's the S&P 500 exchange traded fund. What's the next one?
The Dow.
Dow, DOW. So if you buy an exchange traded fund of the Dow, by definition, you own a part of all 30 stocks that are inside of the Dow Jones Industrial Average. And then the last one.
NASDAQ?
Qs.
Qs.
Qs, right? Yep. The non-financial largest 100 stocks on the NASDAQ that are non-financial driven.
Gotcha.
Right? So those were the big three that were out there. Now there's over 2,000 exchange-traded funds that are out there. When you look at the chart to see the growth that's taking place, the amount of money that's going into exchange-traded funds relative to mutual funds, it is phenomenal. Mm-hmm. Mutual funds still far and away have more money than exchange-traded funds, but it's not because they're gaining traction, they're losing traction. And here is the odd part. And this is not fair. I'm not telling you it's fair. I'm not advocating for it to be fair. But from an exchange-traded fund standpoint, they have better tax rules than mutual funds. It just is.
For now.
And that could change. But in the meantime, let's take all the advantages we can. That's my job. Squeeze nickels, get out sweat, blood, and tears that you work to put in to get the nickel in the first place.
Yep.
Right? And part of that leakage is in fees and expenses. Part of it's in risk and volatility. Part of it's inflation. But a big part of it is in taxes and understanding that tax journey. So the largest owner of exchange-traded funds today are mutual funds. So when Darren sits down with you in your Next Steps meeting, one of the things he's going to do is try to help you in your portfolio transition from things that are inefficient and expensive into things that are less expensive, more efficient, and more known so that we know exactly what it is you own so we can reduce some of that risk and volatility that's inside of your portfolio. Go to yourlifeafterwork.com, get signed up for a Next Steps meeting. If you've got money sitting in an IRA or a 401k, remember, there's no cost and there's no taxes to be able to make the transfer. We're able to trade stocks for free. If you've already retired, that's easy. If you've not yet retired, but you're over 59 and a half, you're probably eligible for an in-service non-hardship distribution. Darren and the team will walk you through that. Go to yourlifeafterwork.com, get signed up for the Next Steps meeting. We'll give you 90 minutes complimentary of things you're going to want to consider today, things you're going to want to consider in the future. And if we choose to partner together, what FEG will do for you, and we'll put it in writing. 800-928-4001.
Need to study my mutual fund history.
Nah.
I've heard Grant bring it up. I haven't heard Aaron bring up the history, but Grant does his version of a history of them too.
That's because he was taught.
Yeah.
All right. 3, 2, 1. Well, good morning and welcome back to Consider This Program, and happy New Year's. I guess it is an anniversary for us. The Financial Enhancement Group turns 25 years old this year. I am your host of Consider This Program, Joe Clark.
And I'm Darren Hardesty.
And we are honored and tickled to have you along with us. It has been an enjoyable 22, 23 years that I've done this radio show program. And I'm happy to have you along, whether you're listening on podcast, whether you're listening on radio, regardless. One of the things that Darren and I and the team do is a program that's called The Better Giver. As you look forward to this year in terms of where it is that you want to give your time and talent, I call it resources, time, money, and energy. There are different things you might want to consider. One of the things that Darren or Grant or Aaron or Dean or Jamie will help you with, our advisory team will help you with, is helping you develop a financial vision in terms of where it is you want to go. I also believe that you need a charitable vision of where you want to go. And I don't say this to offend anyone. I just say it because I think it's important, and that's what I'm trying to do, is to teach. So Barb and I have a charitable vision. Other than our church, we take care of homeless, hungry people and dogs, not cats. Now, that doesn't mean cats are bad. I tend to think they are, but that doesn't matter. My daughter's got one. Both of my daughters have a cat. We just, we want to give money in very, very specific places that we're very, very interested in. And it doesn't mean that fighting breast cancer is not important. It is. Or Alzheimer's. It is. But I think we need to be more focused on where we're giving. So one of the places that Barb and I support is a thing called Second Harvest down in Indianapolis. And, it's somebody asked me and called me out and said, Joe, your show sounds like it's full of information, but you're there to sell something. And it's like, listen, yes, I want you guys to come in for a Next Steps meeting. That's the God's honest truth. We want to sit down and help you to the best of our ability. If we choose to partner together, great. If we don't, that's fine too. But I want to provide information financially so people don't get themselves into trouble without understanding what's going on. So if you want to make a donation because you feel like you should, Second Harvest Food Bank, you can find at 6621 Old Street Road 3. I think it's Old State Road 3, actually, Muncie, Indiana. We've got a new president, new CEO there. We've worked with Tim in the past for many, many years. But again, Second Harvest Food Bank would be a great place. Just put down CTP. Consider this program in the memo. We would appreciate your donation and support. I have no idea what a suggested amount ought to be. You can use your own conscience and guidance for that. I hope you enjoyed the show today. Darren, it was certainly great to have you along.
It's great to be here.
Go to yourlifeafterwork.com, 800-928-4001, and have a great new year.